Hello to everyone. Today I am here with Financial Risk Management Part 4. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Today we are going to discuss about the bank regulation and Basel, important state objective, stable economic environment for private individual and business, providing reliable banking system and protect depositors even in the event of the bank failure. Depositor insurance introduced to build the depositors' confidence. Bank regulate prescribe minimum level of the capital to cover the worst case loss over some time horizon. Basically, in order to keep the economy of any country, the depositors play their key role. If the confidence of the depositors will shake, it will fail the banking system that lead to the failure towards the economic activity. So after having the crisis and when number of banks went insolvent and their depositors affected, after that the Basel brings bank regulations to protect the interest of the stakeholders. What is Basel? BIS is Bank for International Settlement that is situated in the capital of Switzerland named Basel, and BIS established a committee to supervise the interest of the all types of stakeholders related to the banking system. Reason for regulating banking capital: bank regulation is unnecessary. Even if there were no regulations, bank would manage their risk prudently and would strive to keep a level of capital that is commensurate with the risk they are taking. Without state intervention, banks that took risk by keeping low level of the capital equity, deposit insurance may encourage banks for low equity, and due to the cost of the insurance, regulation on the capital bank must hold. The capital a financial institution requires should cover the difference between the expected losses over some time horizon and worst case losses over the same time horizon. The idea is that expected loss are usually covered by the way a financial institution prices its product. We have the example, credit card is considered to be the clean placement and its price is always on the higher side because of higher expected loss chances. For example, the interest charges by a bank is designed to recover the expected loan losses. So that's why they add back as a part of the price of the product equal to its expected loss. Capital is a cushion to protect the bank from an extremely unfavorable outcome. So the capital play a role of shock absorber to absorb the losses in case of the worst condition. The Basel capital framework from Basel 1 to Basel 3. Immediate impact of the Basel 1. What are its positivity? Under capitalized bank improved their capital ratio in response to Basel 1. The ratio of capital to risk-weighted asset for major G10 banks, means group of 10 countries, rose from 9.3% in 1988 to 11.2% in 1996. Common definition of capital and capital adequacy globally, and industry-wide appreciation of concept of the capital management. So these are the positivities related to Basel. There are certain negativities as well. Simplicity of Basel I encouraged rapid growth in products that avoid regulatory capital for the facilities less than 1 year. Even it's for 364 days. So the regulations used to be not applied on such products. Insurance companies selling credit wraps aggravate the impact of a slowdown in the world economic growth because they were more focusing on the short-term facility. The problem with the Basel I, unable to distinguish between the good and poor quality credit. Definitely, if you have a major part of the poor quality credit, it will generate more major part of start increasing a part of non-performing loan. Little impact on risk appetite decisions of the bank. Capital arbitrage opportunity supported growth in the securitization. Capital ratio are misleading indicator of the bank risk. Focus only financial measures lack the mechanism to improve the risk management process. So these are the negativities and the pointed problem that should be addressed. So after the identification of the problem, you go for the further documents or further guidelines. So they bring Basel II. Scope of the application applied on the consolidated basis to the internationally active bank. Financial activity does not include insurance because the insurance cost used to be borne by the depositors. All banks and other financial activities captured through the consolidation. Deduct bank's equity and other capital investment in insurance subsidiaries. Deduct significant investment in commercial entities above the materiality threshold. Now, they start deducting banks' investment in the insurance subsidiary. On one side, they are providing the coverages to the depositors through the insurance companies and banks having their own investments within the insurance company. 4 principles of supervisory review. Banks should have a process for assessing their overall capital adequacy in relation to their risk portfolio and a strategy for maintain their capital. Second one, supervisor, normally the central banks of the countries used to supervise the banks, should review and evaluate bank internal capital adequacy assessment. Supervisors should take appropriate action if they are not satisfied with the result of this process. It's very important. Supervisors should expect bank to operate above the minimum regulatory requirement ratio and should have ability to require the bank to hold the capital in excess of the minimum. So it depends on the financial institution themselves or the regulator that they can ask the banks to maintain their capital adequacy above the Basel threshold. Supervisor should seek to intervene at an early stage to prevent the capital from falling from the below the minimum level. So bank used to warn the bank, and even in some cases they bring administrator if they find that their capital is falling from the minimum level. Other is the market discipline. Disclosure requirement include the general disclosure principles, scope of the applications, capital structure, risk exposure, and the assessment. Basically, the purpose of disclosure requirement is information should be equally informed to all stakeholders, because otherwise some stakeholders can get the benefit from inside information. Arbitrage is a trading strategy that seeks to generate a profit by exploring price difference of identical or the similar financial instruments on different markets or in different forms. So arbitrage is also a very important opportunity for the different stakeholders. If you do not have the inside information, you cannot get the benefit, or you can say only few people can get the benefit from such information. Basel II and the financial crisis acquisition, the average level of the capital required by the new discipline is inadequate. The capital accord interacting with the fair value accounting and cause remarkable losses. Capital requirement based on the Basel II regulations are cyclical. The assessment of the credit risk is delegated to non-banking institutions, that is through the rating agency. Wrong assumption that bank internal model for measuring the risk exposure are superior. That's why they include rating agencies. The framework provides the incentives to intermediaries to deconsolidate from the balance sheet some very risky exposure. It's also very important. Now see you again with upcoming video on Basel very soon. Thank you very much.